In the stock market, doing more work often produces worse results, not better ones. New investors assume constant action equals progress, because that logic works in regular jobs where effort is directly rewarded. Markets do not pay by the hour. Excessive trading usually increases mistakes, costs, and emotional stress, quietly reducing long-term returns instead of improving them. Activity is frequently confused with productivity by beginners who feel uncomfortable staying still. Clicking buy and sell creates the illusion of control and intelligence. In reality, most value in investing comes from decision quality, not decision frequency. Knowing when not to act is a skill that takes time to develop, and it is rarely intuitive for newcomers. The market does not reward effort the way a traditional career does. You can analyze charts all night, read every forum, and still underperform someone who simply stays invested. Returns are driven by exposure, discipline, and time, not how hard you try. Effort without structure often turns into noise, not an advantage. Many beginners approach the stock market like a casino they believe they can outsmart. Small wins reinforce overconfidence, while losses are blamed on bad luck. This mindset encourages risk-taking without understanding probability. Unlike casinos, markets punish impatience slowly, making the damage harder to notice until capital is already gone. The mathematics of loss recovery is widely misunderstood. A portfolio decline feels temporary, but the recovery math is brutal. When an investment falls 50%, it does not need a 50% rebound. It needs a 100% gain just to return to the starting point, a reality many investors ignore. Most long-term capital destruction does not come from dramatic market crashes. It comes from investor behavior, panic selling, overtrading, and abandoning plans at the worst moments. Markets recover faster than emotions do. Poor decisions made under stress often lock in losses that patience would have avoided. The stock market has a low entry barrier, which creates a dangerous illusion of simplicity. Anyone can open an account, but few understand the mechanics beneath price movement. The skill gap is much larger than it appears. Easy access hides the depth of knowledge required to survive consistently. Because access feels effortless, many underestimate the discipline required to succeed. Investing rewards restraint more than brilliance. Without understanding incentives, math, and behavior, beginners confuse participation with competence. The market does not care how confident you feel. It only reflects the consequences of your decisions over time. Institutional investors operate in an environment completely different from retail participants. They access data milliseconds faster, execute trades with lower latency, and deploy infrastructure that individuals cannot replicate. This speed advantage means price adjustments often happen before retail investors even read the information, eliminating any edge based on reaction time alone. By the time news reaches the general public, it is already reflected in the stock price. Markets process information collectively and rapidly. Trading based on headlines assumes you are early, when in reality you are almost always late. What feels like fresh insight is usually confirmation of a move that has already happened. Headline-driven trading is a lagging strategy disguised as analysis. News explains past price movement rather than predicting future returns. Acting on it often results in buying after optimism peaks or selling after fear spreads. This reactive behavior systematically places investors on the wrong side of probability. Most daily market volume is no longer driven by human decision-making. Algorithms dominate trading activity, executing strategies based on statistical edges, not emotion or narrative. Competing against these systems with intuition and headlines is not investing, it is speculation with inferior tools. Retail investors also face structural disadvantages in capital and liquidity. Small portfolios cannot absorb prolonged volatility without psychological pressure. Large players can endure drawdowns and rebalance patiently, while individuals often feel forced to act. Limited capital reduces flexibility and magnifies emotional decision-making. Transaction costs and taxes silently erode returns over time. Each trade feels small, but repeated activity compounds friction against growth. High turnover reduces the power of compounding, even when individual decisions seem reasonable. The invisible cost of action is one of the biggest performance drags. A low share price is frequently mistaken for good value. Investors assume cheaper stocks have more upside, ignoring market capitalization, fundamentals, and risk. Price alone carries no information about quality. This misconception leads to poor allocation decisions and false expectations. There is a critical difference between price and intrinsic value. Price is what the market currently agrees on. Intrinsic value is what the business is worth over time. Confusing the two leads investors to chase movement instead of substance. Sustainable returns come from understanding that distinction. Volatility is not a flaw of the stock market. It is the price investors pay for higher expected returns. Assets that move less tend to reward less over time. Short-term fluctuations feel uncomfortable, but they are the mechanism through which long-term growth is delivered to those willing to endure uncertainty. Beginners usually interpret volatility as danger, while experienced investors treat it as background noise. Price swings trigger fear because they are visible and frequent. Risk, however, is not movement. It is the probability of permanent capital loss. Confusing the two leads to defensive decisions that limit future upside. Markets spend more time recovering than reaching new all-time highs. Growth is uneven and often frustrating. Long stretches of sideways movement test patience, while brief rallies capture attention. Investors who understand this rhythm avoid reacting to every stall, knowing recovery is part of the process. Focusing on daily price changes creates anxiety without adding insight. Short-term monitoring amplifies emotional responses and encourages impulsive trades. Most daily movements have no meaningful connection to long-term outcomes. Constant observation increases the chance of error, not the quality of judgment. Short-term price behavior is effectively random and unpredictable. Even professionals struggle to forecast daily or weekly movements consistently. Attempting to extract patterns from noise leads to overconfidence and false signals. Randomness feels intentional when money is involved, but the data rarely supports that belief. Humans are wired to see patterns, even when none exist. This tendency causes investors to draw conclusions from small samples and recent trends. Charts begin to look like messages instead of statistics. Acting on imagined patterns transforms investing into a guessing game with poor odds. Market timing requires being right twice, once when entering and once when exiting. Missing either decision undermines the strategy. Even correct predictions can fail if execution is mistimed. This double requirement makes timing extremely difficult to sustain over long horizons. Missing the best 10 days in the market can severely damage long-term returns. Those days often occur near periods of fear, when many investors are out of the market. Attempting to avoid volatility frequently results in missing recovery, turning caution into a costly mistake. Human psychology plays a larger role in investing outcomes than most people are willing to admit. Loss aversion causes the pain of losing money to feel stronger than the pleasure of gaining the same amount. This imbalance pushes investors to avoid losses emotionally, even when rational decisions would improve long-term results. Confirmation bias further distorts judgment by encouraging investors to seek information that supports their existing positions. Negative signals are dismissed as noise, while positive opinions are amplified. This selective attention creates a false sense of certainty and prevents timely reassessment when facts begin to change. Overconfidence bias is especially common among young male investors, according to multiple behavioral studies. Early success is often mistaken for skill rather than luck. This inflated self-belief leads to larger positions, excessive risk, and resistance to learning, increasing the probability of severe drawdowns. The endowment effect causes people to value assets more simply because they own them. Investors become emotionally attached to losing positions, treating them like personal identities instead of financial tools. This attachment delays selling decisions and turns small mistakes into prolonged capital erosion. Herding behavior drives many investors to buy near market peaks and sell near bottoms. Social proof feels safer than independent thinking. When everyone appears confident, risk is ignored. When fear dominates headlines, panic spreads quickly, pushing individuals to act in the least favorable moments. Recency bias projects current market conditions indefinitely into the future. Strong performance leads to unrealistic optimism, while downturns create excessive pessimism. Investors assume what just happened will continue, ignoring historical cycles. This mental shortcut replaces analysis with emotional extrapolation. Fear of missing out is one of the most powerful emotional triggers in markets. Watching others profit creates urgency without evaluation. Capital flows into speculative assets not because of fundamentals, but because of social pressure. FOMO turns allocation decisions into reactions rather than strategies. Emotional discipline consistently matters more than raw intelligence in investing. High IQ does not protect against impulsive behavior under stress. The ability to remain calm, patient, and consistent during uncertainty separates sustainable investors from those repeatedly undermined by their own reactions. A lack of diversification concentrates risk without increasing expected return. Many beginners believe focusing on a few positions shows conviction, but it often reflects overconfidence. When outcomes depend on a small number of variables, mistakes become catastrophic. Diversification is not about eliminating risk, it is about preventing a single error from destroying progress. A common mistake is confusing a good company with a good investment. Strong brands, popular products, and impressive growth stories feel safe. However, if expectations are already embedded in the price, future returns can still disappoint. Investment success depends on what you pay, not how much you admire the business. Ignoring valuation multiples when buying popular stocks introduces hidden danger. High expectations require exceptional performance just to justify the current price. When growth slows slightly, prices can fall sharply. Paying attention to valuation is not pessimism, it is acknowledging that future returns are constrained by present assumptions. Using leverage without understanding liquidation risk leads many investors to financial ruin. Borrowed capital magnifies both gains and losses. But losses arrive faster. Small price movements can trigger forced selling at the worst possible moment. Leverage removes patience from the equation and replaces it with urgency and fragility. Chasing past performance is another destructive habit. Assets that performed well recently attract attention, not because of future prospects, but because of visibility. Markets reward anticipation, not celebration. Buying after strong performance often means paying peak prices for declining probabilities. Failing to define an exit strategy before entering a position leaves decisions vulnerable to emotion. Without rules, selling becomes reactive and inconsistent. Investors hesitate when they should act, and act when they should wait. A planned exit is not pessimistic, it is a safeguard against emotional improvisation. Dollar-cost averaging is frequently abandoned when it is most effective. During market declines, fear replaces discipline and contributions stop. This behavior defeats the purpose of the strategy, which relies on consistency through discomfort. The greatest benefit of averaging appears precisely when confidence is lowest. High portfolio turnover rates consistently correlate with poor performance. Frequent changes signal uncertainty rather than skill. Each adjustment introduces costs, taxes, and timing risk. Long-term success favors stable processes over constant refinement. Less activity often reflects stronger conviction and clearer thinking. Unrealistic return expectations are a major driver of excessive risk-taking. Many investors enter the market believing double-digit gains should appear quickly and consistently. When reality fails to match those expectations, frustration builds. This gap between expectation and outcome often pushes investors toward riskier behavior at the worst possible time. Comparing personal performance to the hottest asset class creates constant dissatisfaction. There is always something doing better somewhere else. This comparison mindset encourages unnecessary changes in strategy and allocation. Instead of focusing on progress toward personal goals, investors chase relative performance and lose strategic clarity. The market average return is not delivered evenly each year. Some years are strong, others are flat or negative. Expecting consistency from an inconsistent system leads to disappointment and poor decisions. Long-term averages only make sense when viewed across full cycles, not short evaluation windows. Sequence of returns risk matters more than average returns for retirees and near retirees. Losses early in withdrawal periods have outsized impact on portfolio longevity. This reality highlights why risk management and timing of cash flows are critical. Average returns alone do not capture real-world outcomes. Patience is the specific advantage retail investors possess over Wall Street institutions. Individuals are not forced to justify results quarterly or chase benchmarks. This freedom allows for longer horizons and simpler strategies. When used properly, patience becomes a structural edge rather than a passive trait. Institutions operate under constant pressure from clients, benchmarks, and reporting cycles. These constraints often force suboptimal decisions. Individual investors, in contrast, can afford to wait. Decades matter more than quarters. This difference allows disciplined individuals to outperform without complexity. Boredom in investing is usually a positive signal. A quiet portfolio often means a stable process is working as intended. Lack of excitement indicates fewer emotional triggers and fewer mistakes. When investing feels dull, it is often because speculation has been removed from the equation. Excitement in investing is frequently a warning sign of gambling tendencies. Rapid gains, constant monitoring, and emotional highs resemble entertainment more than strategy. When adrenaline replaces analysis, risk increases silently. Sustainable investing prioritizes calm progress over thrilling stories and short-term stimulation. Long-term success begins by shifting focus away from beating the market and toward participating in the market. Trying to outperform creates constant pressure and comparison. Participation emphasizes consistency, exposure, and survival. Over time, simply staying invested captures the market return, which already exceeds most individual attempts at outperformance. Adopting a passive strategy statistically outperforms the majority of active beginners. Passive investing removes prediction and replaces it with structure. It accepts uncertainty instead of fighting it. By reducing decisions, investors reduce errors. This simplicity is not laziness, it is an evidence-based response to market reality. Automating investments removes the emotional decision point entirely. Contributions occur regardless of headlines, moods, or market sentiment. Automation transforms good intentions into consistent behavior. When emotions are removed from execution, discipline no longer depends on willpower. It becomes a system that operates quietly in the background. Defining a clear time horizon determines appropriate asset allocation. Short goals require stability. Long goals can tolerate volatility. Without a horizon, risk feels abstract and unsettling. When time is defined, fluctuations gain context. Allocation becomes a rational match between objectives and uncertainty, rather than a reaction to market noise. Risk management must take priority over profit maximization. Surviving market downturns matters more than capturing every upside opportunity. Losses that force exit eliminate future potential entirely. Managing downside preserves the ability to benefit from compounding, which is the true engine of long-term wealth creation. Understanding that doing nothing is often the best action is one of the hardest lessons to learn. Inaction feels irresponsible, yet constant intervention usually harms results. Markets reward patience disproportionately. Knowing when to stay still requires confidence in process rather than confidence in prediction. Financial literacy is the primary defense against market predation. Complexity often hides incentives that benefit intermediaries, not investors. Education clarifies costs, risks, and trade-offs. An informed investor is harder to exploit, less reactive, and more capable of maintaining a coherent, long-term strategy. Survival in the market over long periods naturally leads to success. Time allows compounding to work and mistakes to be absorbed. Investors who remain disciplined and solvent benefit from recovery and growth cycles repeatedly. Longevity, not brilliance, is the most reliable path to sustainable investing outcomes.